Hey guys, Dave Keller here with Market Misbehavior. As we start the new year, 2022, we're looking at the chart of the S&P 500. Certain price levels are becoming more obviously important, and that has been the case many times in market history, but particularly right now. 4,700, which we're approaching currently this week, 4,550, a little further below, where we found support. It's all based on a technical concept called polarity. So today, why is S&P 4,550 so important? So the technical analysis toolkit includes a lot of discussion about support and resistance levels. And these are sort of ceilings and floors in the market. To think about it a different way, right? A level of support is a floor, a level below which we're unable to go because buyers come in and additional demand takes up all the additional supply from the distribution going lower. A resistance level is a level of a ceiling in the market, a level above which we're unable to go because buyers are not able to overcome that previous resistance, or to put it another way, there's not enough demand to overcome the supply that's in the market. A concept that comes up when you're looking at charts, particularly support and resistance levels, is polarity. We're going to look at the chart of the S&P 500, talk about what polarity means and why S&P 4550 continues to be a very important level in the financial markets. Until we get there, though, just wanted to remind you, if this sort of thinking about decision-making, investor behavior, charts, technical analysis, breadth, sentiment, price momentum, all of that is of interest to you, I hope you'll subscribe to my channel. It'd be awesome to have you along this ride here in the new year. Also, give the video a thumbs up if you appreciate it. We'd very much appreciate that back. Also, put a comment below. Do you agree that S&P 4550 is an important level? If not, what levels do you think are even more important? Let's get to the chart. All right, so here we're looking at the S&P 500 for the last 12 or 13 months. So basically looking at the entire calendar year 2021, and then the very new 2022 there on the far right side of the chart. What's interesting this week is we are going right down to the 50-day moving average. And what's interesting, of course, is many times last year, 1, 2, 3, 4, 5, 6, 7, 8, 9, I'm kind of fudging it. We'll say 11 times, 11 or 12 times in 2021, we tested the 50-day moving average. One of those times we actually failed and managed to close below the 50-day moving average for a number of days. Ended up being that pullback phase there where there was a bit of choppiness before the resumption of the previous uptrend. Every other time we hit the 50-day moving average, the S&P found support and moved higher. I'm going to put a link to the video. I recorded a number of videos last week or last year on the 50-day moving average, but one in particular that I'd encourage you to check out if that sort of thinking is something you want to dig into a little deeper. But today we're going to talk about a concept called polarity. And what polarity means is basically, number one, we have to talk about support and resistance levels. Levels of resistance are sort of ceilings in the market, levels above which we're unable to go. They're sort of the prices that stick out in the upper end of this trend as you're looking up. A level of support is a level below which we're unable to go. So looking mid-September of last year, late September, early October, we bounced off that 4,300 level. So you consider that a level of support. And as you can see from these shaded areas on my chart of the S&P 500, I love to key in on key support and resistance levels because markets tend to have memory. And what I mean by that is this concept of polarity. A lot of times you'll find a level that was a resistance level. So for example, in April of last year, we rallied up to just around 4,200. Then you can see we bounced off of 4,200 a number of times. Every time we attempted to get above 4,200 for about 6 weeks, we're unable to do that. We tested it a number of times. Finally, we broke above there in mid-May, but look at what happened after that. We tested 4,200, really 4,150 from above a number of times. That's called polarity, where a level of resistance becomes a level of support. You'll see that a number of times and on a lot of charts when you look at. So for example, here in July, sort of that 4,350 to 4,400 level became resistance. We broke out and that became support in August before rotating higher. Here we can see the 4,550 level was resistance in September of last year. We broke out and then that became support in December. And now this week, we're once again experiencing that phenomenon of polarity, a level of resistance from November and December around 4,700. We finally broke above there toward the end of last year, and now we're testing that level from above. And even though we've traded a little bit below there, I still would consider this level being held. And I tend to think of support and resistance not as absolute levels, I don't think the markets are that precise at this point. I would argue they're more support and resistance ranges, which is why I tend to illustrate these not as just horizontal lines, but as shaded areas, because I think there's a little bit of wiggle room given decimalization and a lot of different market participants coming at stocks from a lot of different ways. So what does that mean? It means once a chart establishes a level of resistance and breaks out, when you pull back to that level, you will often assume that there will be support there. And a classic breakout technique is to look for a chart that is broken above a previous resistance level, retested that from above and held it. And as long as we remain above that support level, overall, the new trend is positive. And that breakout is a good one, the one that you should be able to follow. That's what we saw in November and December. That's what encouraged us to be optimistic going into the end of last year. Now we have a breakout level around 4,700. We have tested it a number of times. We broke out in late December. We're now testing that from above. As long as 4,700 holds, I would argue the overall structure of the market is bullish on this time frame because it's able to break out above previous resistance and hold those breakout levels when the price comes in retests it from above. And again, demonstrating this concept of polarity. So why is 45.50 so important? Well, if you look at the last 6 months, you can see that 45.50, that level has become very, very important. This demonstrates that polarity, the high from September, the breakout in late October, the test as support in November and December, and now we've rotated above there. As long as we remain above 45.50 overall on the medium-term time frame, looking out a couple months, overall, that seems to be fairly constructive. So in the short term, we have a level of support, 4,700, based on polarity over the last 6 weeks. If you look at 45.50, it's really a similar idea, level of polarity based on the last really 4 to 6 months, looking at that level of resistance that now is being held as support. Those breakout levels are really important to watch. And if you look at a lot of charts last year, some of the frustrating charts, it would be something like the Russell 2000, the IWM, which I can bring up here really quick. If you look at the IWM, which is the Russell 2000 ETF, you can see it attempted to break out in November of last year, breaking above previous resistance. So the concept of polarity would suggest that you should expect support around that 230 to 235 level. That's the level of resistance from earlier in the year. It did not hold. So polarity did not hold in this case, which told you that the chart was no longer constructive. That breakout was not validated because you did not hold the previous level of support using this concept of polarity. So that's what polarity is: support becoming resistance or resistance becoming support. And in this case, why 45.50 and in the short term 4,700, why those are such important levels for the S&P 500. So that is the concept of polarity. You'll hear that term thrown out sometimes. You'll see it written about from technical analysts because they're talking about in this sort of bull market phase, it's more often a level of resistance that then becomes support. It's worth noting that in a downtrend, if and when everything starts to rotate lower, if we get another secular bear market at some point, not today, it does not appear so, but at some point when overall trends start to turn lower, you'll find a lot of times level of support will break down and then that becomes resistance. Maybe on some of the ARC charts, things like Tesla and others, you will zoom, you may see that sort of phenomenon. That is the concept of polarity and why 45.50 and to a lesser degree 4,700 are so important. If this sort of thinking about technical analysis based on investor behavior and decision making is of interest to you, I hope you'll subscribe to my channel. It would be awesome to have you along this ride going forward here in 2022. Also, give the video a thumbs up if you liked it. We would very much appreciate that back. Finally, put a comment below. Do you agree with the importance of 4,700 and 45.50? If not, what levels do you see as most important on the S&P? Let me know in the comments below. From everyone at Market Misbehavior, I'm Dave Keller. Be well, stay safe. Talk to you again soon.